So, good day everyone. Our lesson for today is about the role of a financial manager or the role of a finance manager. So, we all know that each organization has its own, most probably has its own either business department, finance department, uh, and the like. No? The different organizations have different names of its department, pero there is a certain department which should be really intended about the financial aspect of the organization, and that department is headed by a finance manager, financial manager, controller, finance officer, finance head, and the like. No? Chief finance officer. There are a lot of actually names, but we will be talking, or even though they are a finance manager is working on different industries, a certain finance manager will really have the basic functions. So we will be talking in this video about the role of a financial manager, or what are the basic roles of a financial manager. So, financial activities of a firm is one of the most important and complex activities of a firm. Therefore, in order to take care of these activities, a financial manager performs all the requisite financial activities. So, syempre, since we are in a business organization or in a business perspective, the financial activities or the flow of finances is really important in our respective organization. So it is deemed important, it is deemed necessary that someone will really have to devote his or her time to the oversee, to check, and to have an overview of what are the activities or the financial activities of the organization. So everything included in the financial activities, in all financial transactions, all financial decisions should be made with the basis or with the recommendation of the finance manager. A financial manager is a person who takes care of all the important financial functions of an organization. The person in charge should maintain a farsightedness in order to ensure that the funds are utilized in the most efficient manner. His or her actions directly affect the profitability, growth, and goodwill of the firm. So, as what I have said, a financial manager, of course, is a person who is in charge of of overseeing the financial activities, the financial decisions, the forecasting of finances, di ba, of the organization. Here, it is said that the finance manager should maintain a far-sightedness. So what do we mean by far-sightedness? It means the finance manager can predict or forecast, di ba? Can forecast the financial needs, the financial activities, or the financial requisites of the organization. So, yung farsightedness na nakalagay, it only symbolizes, or it only depicts the forecasting ability of a finance manager, because the financial manager should not only be focusing on the present finances of the organization, but he or she should also have an overview or a backside of what will happen in the organization, what will happen in the financial aspect of the organization. So, for example, the organization or the business will decide to have an expansion project, or they will be branching out. So, what are the financial requirements needed with that decision? How much capital or how much money is needed to make sure, or in order to make that branching out a reality, di ba? Of course, the financial manager will really make sure, or is the one responsible in securing the financial aspect needed by the organization. So the following are the main functions of a financial manager. So You can be a finance manager in different of an industry which is separate from another industry. Pero most probably, a finance manager will just have the same or the same aspect or the same responsibilities. Kahit na anong industry ka pa, whether you are working in a production company or a manufacturing company, or you are working in a service company or a merchandising company, a finance manager will always have the similar functions. So here are the main functions of a finance manager. Number one is raising of funds. So in order to meet the obligation of the business, it is important to have enough cash and liquidity. A firm can raise funds by the way of equity and debt. It is the responsibility of the financial manager to decide the ratio between debt and equity. It is important to maintain a good balance between equity and debt. So most probably, the finance manager is the one responsible of deciding or who is in charge of how are we going or how an organization will raise its funds, di ba? Because any organization naman kailangan niya ng pondo. So where will we get the fund needed for the operation, for the expansion, for the payment of bills, and etc. So in that case, the finance manager will make sure that will determine what is the most efficient way of raising funds. Diba? Kasi commonly, we have two sources of funds. We have equity and debt in business. Diba? So when we say equity, it means, especially in big organizations, it means the capitalization. So mag-o-offer ba tayo ng additional shares of stocks, or will we be offering bonds? Mag-request ba tayo sa Securities and Exchange Commission or SEC ng additional shares para ibenta natin para sa general public para magkaroon tayo ng additional fund or so, or uutang tayo? Now, a lot of businessmen will say that a good businessman has a debt, di ba? We have a common perspective that a good person has no debt. But a good businessman will incur a certain portion of debt. Or when you say debt, it's utang. Di ba? There should be a balance between a good number of equity or a good portion of debt. So the finance manager, the financial manager will determine how much equity are we going to sell or i-request natin na i-offer sa public, or how much ang iutang natin sa bangko or sa financial institutions. So that's one of the main functions of a finance manager, whatever industry he or she belongs. Another one is allocation of funds. Once the funds are raised through different channels, the next important function is to allocate the funds. The funds should be allocated in such a manner that they are optimally used. In order to allocate funds in the best possible manner, the following point must be considered. Number one, the size of the firm and its growth capability, status of assets, whether they are long-term or short-term assets, mode by which the funds are raised. These financial decisions directly and indirectly influence other managerial activities. Hence, formation of a good asset mix and proper allocation of funds is one of the most important activity. So here, in the allocation of funds, we already raised the funds needed. Paano na lang natin siya i-allocate, di ba? So, of course, it is said here that we need to consider three main points. Yung size ng firm, so how big is the organization, or how big the organization plans to be, di ba? For example, we are just now one branch, but we are forecasting, or we are planning to open up different branches. So that's one of the main consideration. Second is the status of assets. So we know that there are long-term assets and there are short-term assets. So what is the main, what classification does our assets have? Are long-term ba siya or short-term? And of course, mode by which the funds are raised. Benta ba tayo ng shares? Nagbenta ba tayo ng bonds, ng offer ng bonds? Nag-utang ba tayo sa bangko or sa financial institutions? So those are the important things that we need to consider in allocating our funds na ginaraise. Next is profit planning. Profit earning is one of the prime functions of any business organization. Profit earning is important for survival and sustenance of any organization. Profit planning refers to proper usage of the profit generated by the firm. Profit arises due to many factors such as pricing, industry, competition, state of the economy, mechanism of demand and supply, cost and output. A healthy mix of variable and fixed factors of production can lead to an increase in the profitability of the firm. So of course, we all know that in order for the business to survive, it should have profit. No businesses can survive kung tuloy-tuloy na losses ang gina-consider niya. So as finance manager, the finance manager should make sure that the business are generating adequate profit na hindi lang siya break even. So when you say break even, wala siya sa profit, wala po siya sa losses. So a good finance manager will determine to have an adequate amount of profit that will make the survival of the business good, di ba? As what I have said, no businesses is planning to operate for a long period of time na tuloy-tuloy ang losses niya. So profit is necessary. And then if there is already a profit, where will it go? Diba? Will we give dividends to our shareholders? Will we retain the profit and use it in the operations of the business? So or we will pay our short-term or long-term debt. So where will the profit go? So that's one of the main functions of the finance manager, to determine how much profit do we need and what will we do with our profit. Fixed costs are incurred by the use of fixed factors of production such as land and machinery. In order to maintain a tandem, it is important to continuously value the depreciation cost of fixed costs of production. An opportunity cost must be calculated in order to replace those factors of production which has gone through wear and tear. If this is not noted, then these fixed costs can cause huge fluctuations in profit. So I know that you are already familiar what is fixed cost, what is variable cost, and what is opportunity cost. So just a review, a fixed cost, these are costs or expenses incurred by the business which is fixed. So including dyan depreciation, di ba? Hindi yan nababago. Rental of, let's say, the office space or the production. Usually the overhead, the salaries and wages, usually that is fixed, di ba? Yung variable cost naman varies depending on the operations of business. Like for example, raw materials. So the more production you want, the more raw materials you buy. Di ba? Whereas yung fixed cost, mag 1,000 production ka man per month or mag 3,000 production per month ka, the rent expense is the same. So that's the fixed cost. Kaya nga fixed siya, fixed. So opportunity cost naman, these are the costs or the expenses of possible opportunities which were missed or which were being grabbed by the organization. So let's understanding capital markets. Shares of a company are traded on stock exchange, and there is a continuous sale and purchase of securities. Hence, a clear understanding of capital market is an important function of a financial manager. When securities are traded on stock market, there involves a huge amount of risk involved. Therefore, a financial manager understands and calculates the risk involved in this trading of shares and debentures. It's on the discretion of a financial manager as to how to distribute the profits. Many investors do not like the firm to distribute the profits among shareholders as dividend. Instead, invest in the business itself to enhance growth. The practices of a financial manager directly impact the operation in capital market. Yes, because there are already a lot of publicly listed companies, di ba? When we say publicly listed, they are already listed or they are being sold in the stocks exchange, or here sa Philippines, we have Philippine Stocks Exchange. Sa US, they have the New York Stock Exchange. So, ano yung stock exchange? It is like just a market of stocks. So, you buy stocks, you sell stocks, or you buy stocks for investment. So again, we know that stocks or owners of shares of a corporation are considered the owners of the corporation. So of course, the finance manager should determine, or the decision of the finance manager, which will reflect the decision of the company, greatly affects the stocks exchange operation or market of a business. Diba? Especially if there is a good activity by the firm, tataas yung stocks niya, yung market niya sa stocks. So we know yung market value is different from book value. So yung market value is how much ba ang value ng stocks nga na sa market or sa Philippine Stocks Exchange. Whereas yung book value is how much is the amount of each stock as per recorded sa books ng organization. So whatever activities involved by the firm or the organization greatly affects the market value of the stocks being listed. So let's, for example, yung pag-deny ng franchise ng ABS-CBN, talagang there was a sudden change or sudden downturn of the amount or the per share of ABS-CBN. So that dati, it was 67, 60 plus per share. But because of the denial of franchise, parang naging 40, 30 pesos per share na lang siya. So the activities of the firm, or maybe the activities or the decisions of the finance manager, which will reflect as the decision of the organization, greatly affects the standing of the shares of stocks in capital markets. So let's talk about capital structure, the meaning and the factors determining capital structure. So the meaning of capital structure. Capital structure is referred to as the ratio of different kinds of securities raised by a firm as long-term finance. The capital structure involves two decisions. Number one, the type of securities to be issued are equity shares, preference shares, and long-term borrowings or debentures. Second is relative ratio of securities can be determined by process of capital gearing. On this basis, the companies are divided into two. We have the highly geared company and the low geared company. So in highly geared companies, those are companies whose proportion of equity capitalization is small. Medyo mababa yung equity, mataas yung utang. Diba? Sa low-geared companies naman, those companies whose equity capital dominates total capitalization. So mas malaki yung equity capital compared sa debentures and preference shares. So what are the factors determining capital structure? So we need to discuss now what are the different factors that affects or that can greatly affect the capital structure of an organization. We have trading on equity. The word equity denotes the ownership of the company. Trading on equity means taking advantage of equity share capital to borrowed funds on reasonable basis. It refers to additional profits that equity shareholders earn because of issuance of debentures and preference shares. It is based on the thought that if the rate of dividend on preference capital and the rate of interest on borrowed capital is lower than the general rate of companies' earnings, equity shareholders are at advantage, which means a company should go for a judicious blend of preference shares, equity shares, as well as debentures. Trading on equity becomes more important when expectations of shareholders are high. So, of course, this is really true with big organizations na talagang active sila on the stock exchange because yung common shareholders can really determine where will the company go, what does the shareholders decision, or what is the the purpose of the shareholders of buying the stocks. The degree of control. In a company, it is the directors who are so-called elected representatives of equity shareholders. These members have got maximum voting rights in a concern as compared to the preference shareholders and debenture holders. Preference shareholders have reasonably less voting rights while debenture holders have no voting rights. If the company's management policies are such that they want to retain their voting rights in their hands, the capital structure consists of debenture holders and loans rather than equity shares. Of course, kasi in voting, di ba, the common shareholders or the equity shareholders will elect for a board of directors, which is the governing body or the law-making body of the organization. So of course, if the shareholders through the board of directors wanted to maintain their control or to maintain their voting rights na hindi siya maapektuhan, that their voting right will not replenish or will not diminish, of course, they will be determining now or they will be now pro debentures or mas i-prefer na mag-utang or mag-issue ng preference shares compared to common shares because usually it is the common shareholders that has a maximum voting. The preference shareholders has lesser voting, and of course, if it is an utang to an outside company, they have no decision control of the business. Flexibility of financial plan. In an enterprise, the capital structure should be such that there is both contractions as well as relaxation in plans. Debentures and loans can be refunded back as the time requires, while equity capital cannot be refunded at any point, which provides rigidity to plans. Therefore, in order to make the capital structure possible, the company should go for issue of debentures and other loans. So, syempre, that will really applying for debentures or getting debentures or utang will require the company to pay monthly interest or monthly amortization. Whereas kung mag-offer sila ng equity shares, they are not really required to to distribute dividends because dividends are usually produced when there is profit and when the board of directors decides to distribute so if kailangan talaga na ng pera for a long period of time without planning to pay or or magpalabas ng pera every period, so they will go for equity shares and not for utang because if they will be pursuing to apply for a loan, then they are mandated, they are required to pay the monthly amortization. Choice of investors. The company's policy generally is to have different categories of investors for securities. Therefore, a capital structure should give enough choice to all kinds of investors to invest. Both Bold and adventurous investors generally go for equity shares, and loans and debentures are generally raised, keeping into mind conscious investors. So that's self-explanatory. Capital market condition. In the lifetime of the company, the market price of the share has got an important influence. During the depression period, the company's capital structure generally consists of debentures and loans. While in period of booms and inflation, the company's capital should consist of share capital, generally equity shares. So, syempre, if there is a depression, economic depression, so medyo less ang pera, medyo gipit, di ba? That is what is the layman's term, medyo gipit. So, most probably, utang. Because no one can, or it is not the priority of general public. So, walang pera, general public, so utang tayo. Whereas naman kung there is inflation, there is a big flow of money, then we need to get or to raise funds through equity shares and not through utang. Period of financing. When company wants to raise finance for a short period, it goes for loans from banks and other institutions. While for long period, it goes for issue of shares and debentures. Of course, because as what I have said, loans will have a shorter period of payment, di ba? Usually after 2 years, wala na. Or after 1 year, wala na. Pag nabayad, fully paid na ang utang. Whereas equity shares, it will go for a long period of time na you are distributing the ownership of the business for a long period of time. And of course, the cost of financing. In a capital structure, the company has to look to the factor of cost when securities are raised. It is seen that debentures at the time of profit earning of company prove to be a cheaper source of finance as compared to equity shares, where equity shareholders demand an extra share in profit. Stability of sales. An established business which has a growing market and high sales turnover, the company is in position to meet fixed commitment. So medyo there is an availability of fund that can pay the monthly amortization of loan. So interest on debentures has to be paid regardless of profit, because interest on loans is not a variable, di ba? Na kung wala ka sa income, wala ka sa bayadan ng interest. But interest on loan is a fixed expense or a fixed cost, because you need to pay that whether or not you have an income or wala, whether or not gabay lang ang profit or the. So therefore, when sales are high, thereby the profits are high, and company is in better position to meet such fixed commitments like interest on debentures and dividends on preference shares. So if the company is having unstable sales, fluctuating, then the company is not in position to meet fixed obligations. So the best option is equity capital. The size of the company. Small-sized business firms' capital structure generally consists of loans from banks and retained profits. Of course, diba, especially with sole proprietorship, diba, yung common na yan siya nga, ang capital nila, ang capital structure is from loans or retained profits. So, ang benta sa tindahan, ipalibot na lang, i-rolling. So while on the other hand, big companies having goodwill, stability, and an established profit can easily go for issuance of shares and debentures as well as loans and borrowings from financial institutions. The bigger the size, the wider is the total capitalization. So that's the end of our discussion. Hopefully you learned something, and we will see again next time. Thank you.